Joining us now, Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. So your forecast for the year, Lori, you're looking for 7, 8, or 9% gains in equities this year. Everybody's right in that range. Are you too? It's January, and I don't envy your job trying to do it. But if everyone's at 7, 8, or 9, it's probably not going to be 7, 8, or 9. It could be down, it could be up 25.
Mm-hmm. No, look, I think that we view price targets as a compass as opposed to a GPS, right? They're a statement of direction of travel. Are we bullish? Are we not? And why? Our number is 77.50 for year end. It's a 12-month price target. We have 5 models that go into it. If you look at it relative to
77.50 for year end. Year end. Now, I want to make this very clear. That's year end. That's the end of 2026. 77.50. Very interesting. That could possibly happen. That's a very interesting year-end target. Let's continue the rest of the video, and then I'll give my perspective at the end of the video.
The December 31st close, we were actually one of the higher numbers on the street with about a 13% gain. And what I think is important about that 13% number, Joe, is that if you look at bottom-up consensus earnings growth in the S&P 500, at the time we put this target together, that implied earnings growth rate from the consensus numbers was about 13%. It's now drifted up to about 14%. But more or less, our appreciation forecast in terms of price is right in line with that earnings growth number. So we're not looking for multiple expansion. We're not looking for a big decline in the multiple. We think this market is going to get what it deserves, but from an earnings perspective.
That is the way I've been thinking about it too. When we have people on it and myself, first you'd have to decide, will multiples contract because they're a little bit rich. And if you decide, well, rates are coming down or at least maybe staying where they are, I don't know what the Fed does. But let's say that multiples only come down 1 or 2 percentage points. If you're getting 14% earnings growth, which is, I think, easier to quantify, hopefully, unless there's something looming that we don't know about. But if you do 14%, the market should be able to trade higher just based on that. I don't know how much.
No, I think that's fair. And, I won't nerd out with you too much just in terms of our modeling, but we do have one of the 5 models is based on valuation and earnings. And we actually use inflation forecast, Fed fund forecast, and 10-year yield forecast, just the consensus numbers, not Lori making up her own thing. And when we put those numbers in, and it's like a 2.7% inflation rate on the average for 4Q, like one more cut from the Fed, and 10-year yields basically staying flat. When we do that math, our regression analysis, which goes back to 1962, suggests that the PE multiple should stay flat with where it was in 2Q. So, we have these, kind of general ideas of what we think the market deserves to do, but we have actually dug in and really looked at some of the math that also justifies that idea as well.
That's pretty interesting and useful. I think that it's actually a rigorous way of saying multiples probably don't necessarily rise, but don't contract. I could make a case for multiples even rising with AI or productivity or inflation being more under control than people think. So then any risk really is that we're miscalculating earnings per share growth. We could be thinking it's more than it's going to be, or we could be underestimating. If it's 4% GDP, earnings per share growth could be even higher than 14%.
I think that's a good way to look at it. I think that's one of the wild cards you have to look at. And frankly, when we dig into the earnings number, one of the things that's given, kind of the top-down forecasting community trouble with forecasting earnings in recent years are the margin assumptions, because we've just been seeing tremendous margin expansion. And I will tell you, as someone, I use the bottom-up consensus now. I used to try to do my own earnings forecast top-down, and the margin issue was always very tricky because any sort of macro variables that helped explain margins in the past just don't work anymore. And I think that's because we're in this sort of renaissance of productivity and technology, not just the tech companies expanding their margins, right, but other companies using these tools as well. And that's why I think earnings have been so resilient. And, you do kind of have a bias that they're going to meet those numbers or perhaps surprise a little bit.
And those could be positive things for margins. And then you got tariffs, which could be, were forecast to be really negative for margins because people were or companies were eating some of the tariffs, not necessarily passing them on immediately. So that was on the flip side. You don't think that's going to be an issue?
Well, Well, it's interesting, Joe. We did a little bit of an experiment with the 3Q data. So we looked at the consensus margin assumptions by sector and how they were ahead of the 3Q reporting season and then where they ended up. And the overall S&P 500 number didn't move that much, but if you looked at the sectors themselves, we saw tech come in well ahead of expectations. There's one other sector, I think maybe materials, that came up. And then we saw, some of the other tariff related sectors like industrials actually come in lower. And so kind of the strength that you were seeing in kind of that AI part of the economy was offsetting some of the hits that you took from tariffs. And the hits from tariffs weren't terrible, but it was interesting when you really kind of dug into the guts of those numbers, how one issue offset the other.
That's a very interesting perspective. And that was a great explanation from this expert here, from this person analyzing the markets. Great explanation, great perspective on the S&P in terms of her year-end target 7750. Very interesting. I think that she mentioned a couple of points which I think that I agree with in terms of the S&P, in terms of the year-end target. Three things that I think could could potentially help propel the S&P higher. One thing could be the earnings growth. So we could have double-digit earnings growth in the overall market from, the Magnificent Seven stocks and from other sectors as well. So we could have great earnings growth. That's number one. Number two, we can have great expanding margins, so expanding profit margins from companies, utilizing AI and having that AI productivity. So that's the second thing. And last but not least, if we do get more Federal Reserve rate cuts this year, then that can help propel the market. So those three things, right? Expanding earnings growth, expanding margins, and Fed rate cuts. I think those three things could possibly help the markets, propel the markets to new all-time highs by the year end, right? I want to make this clear, by the end of 2026. So her this expert's year-end target is 7750. I think that's very interesting. I think that's very possible. And later on in the video, I would show you guys what this looks like on the chart because I think that's very possible. I think that the S&P could possibly reach possibly as close to 8,000 year-end. But I just want to let you guys know that anything can happen, right? So just want to let you guys know that. And also too, welcome back to another channel. Welcome back to my channel. Welcome back to another video. So yeah, so I think those three things will help propel SP by the end of the year to 7750. I think that she made some amazing points. Expanding margins, earnings growth, and Fed rate cuts. I think those three things will help propel the markets even higher, especially the S&P 500. So later on in the video, I will show you guys what this looks like on the chart on all of the major indices. I'm gonna show you guys what it looks like in the upside and on the downside. So just to give you guys a clear picture that let's say if that doesn't happen, let's say if we don't get to that year-end target, if the market comes down because there is a possibility that the markets could come down in 2026 in the first half of the year, possibly in the short term. We could have a big pullback or big draw or pick a big pullback in the S&P and in the other major indices as well. So I just want to let you guys know that. So that's the first video we're reacting to. And then the second video, there's another expert that's going to go over more of their perspective on the S&P. And then after that, I'll show you guys what this looks like in terms of technical analysis. All right, guys. So let's go into the second video.
Take a look at the futures right now. Dow off about 30 points. NASDAQ off about 13 points. The S&P 500 off just about 4 points. Joining us right now is Kevin Mine, President and Chief Investment Officer of Hennian and Walsh Asset Management. Good morning to you, sir.
Good morning, Andrew.
Okay, so here we are on Christmas Eve. What do we think 2026 could possibly look like?
Yeah, what a year this has been, right? 41 record closes for the S&P 500, a total return of just over 18%. And we reached the 3-year anniversary of this bull market run. So what do I think 2026 is going to look like? I think it's a continuation of this bull market, albeit with much more volatility than what we saw in 2000.
But does that mean we're living in a...
I agree with that. I think that the S&P can reach a new high with some pullbacks here and there. I think that we're probably gonna have a major pullback before we have our next leg up on the S&P 500. And as I said to you guys before, I'm going to show you guys what this looks like on the charts later on. But he mentions a great point here. I think that we may have a great year on the S&P. based on what I'm seeing in the charts, we could have a pullback and then, we could have some upside after that. The S&P could possibly make new all-time highs, or even the short term, the S&P can make new all-time highs because levels on the markets can always be negated and levels can always be passed. So just be very mindful of that. But he's making a very good point that the aspects of volatility. I think that this year we will have a lot of volatility as well. That's something that he mentioned. That's a very good point as well. So very good point about the volatility. I think that in the short term, based on what I'm seeing in the charts, we may have a big pullback. We may have a minimum 10% pullback or even more with a lot of volatility, and then the markets may prepare higher for its next leg up. So let's finish the rest of it, and then I'll provide my perspective here and there in between. But then at the end of the video, I'll give you guys like an explanation from both videos, basically summarizing what each of these analysts are basically saying.
You think if we're sitting here together a year from now, double-digit growth?
I think we have another double-digit growth year, but I think certain areas of the market are going to perform much better than other areas of the stock market. And
I agree with that point too. That's another point. Now, what this means is that when certain areas of the market perform better than others, many times in the financial markets, this is called sectoral rotation. This is when money is rotating in between sectors, meaning that let's say the Magnificent Seven stocks had a massive run up. Like for example, Magnificent Seven stock had a massive run up in the past 6 to 7 or 8 months. Then there may be some rotation of capital from the Magnificent Seven, from the technology stocks into other industries. Let's say healthcare, or the small caps, or other industries, or the industrials, right? So there may be some capital rotation into other sectors outside of tech. So that's something that I want to explain to you guys, that he's explaining here, that some industries, he could be right on that. Some industries may perform better than others in terms of their returns. So let's say, for example, healthcare, for example, could possibly perform better than tech, right? Or industrials could possibly perform better than healthcare, right? Or consumer staples could possibly perform better than healthcare, right? So that's what that means, right? When different industries when one industry is perform better than the other, given the particular and given the macroeconomic conditions within the markets, and given different macroeconomic factors, that means that there's sectoral rotation happening in the market. That means money is rotating in different sectors, rotating from one sector probably to another sector to see where is the next potential leg up and where is the catalyst, right? Always remember that when markets go up, anytime when markets go up, right, there has to be a catalyst that sends markets higher, right? Has to be a catalyst for markets to have their next leg higher. Always remember that.
to follow the money, that's going to lead to where all of the growth opportunities are. When I say follow the money, I don't necessarily mean where the flows are going, but where is the money being spent? And we know that the money is being spent on areas such as AI infrastructure, aerospace and defense, biotech, and of course, power solutions, the all important power solutions that are going to keep this AI revolution going.
Some people talk about it broadening out
Yes.
to all sorts of other things. I mean, do you think the S&P is just going to be a Mag 7 play, basically?
No, I think the Mag 7 influence has been weakening.
Right.
3 years ago, 62% of the total return of the S&P 500. Last year, it was about 52. Right now, we're around 44%. So it is weakening. But if you look to areas such as industrials, look at the cooling solutions, look at the data center plays, but even beyond that.
And I just mentioned industrials, right? Interesting that he's mentioning that. I just mentioned industrials just probably a couple of minutes ago, right, or seconds ago. But interesting that he's mentioning that.
Let's talk about healthcare for a second, biotech. We know that Washington continues to pressure large cap pharma to lower their drug prices. We know there's many large revenue producing drugs coming off of patent and being subject to generic pricing. So what are these large cap pharmaceutical companies going to do to replace all that lost revenue potential? They're going to have to be acquisitive, and that brings opportunities for small cap.
How important to your sorry.
I just want the double-digit gains.
Yes.
Is that because earnings grow double digits?
I think we're going to get a lot of earnings growth, and we're going to get additional spending. And there's
So
also
the multiple stays where it is. So the multiple stays where it is.
Yeah, the multiple stays where it is. It's going to be still above
rich.
its 5 and 10-year averages. It is rich, and I think some of the more rich areas are ripe for a pullback. But that doesn't mean those other areas.
So it just the market tracks the earnings per share growth and goes up double digits based on, and it does that Why? Because of the big beautiful bill, or because of the momentum in the economy, or
Yes, yes.
it does it in spite of tariffs? It does it because of tariffs?
I think there's multiple tailwinds. I think we have deregulation on the way. I think we have the prospects for billions of dollars of spend on the AI infrastructure play, which will keep that investment opportunity going. And we also know that there's going to be opportunities as it relates to the market itself in terms of historical dynamics. Over the last 50 years, we've had 5 times when this bull market has hit its 3-year anniversary. All 5 times it continued to move higher by an average total duration of 8 years, Joe.
Yeah.
That would suggest we got 5 more years to go. Of course, this time could be different, but I do think there's
People
more
are pointing out 4.3% GDP in a weakening labor market means productivity is going up. The drone on dice, maybe is it AI?
Yeah, I think AI has a lot to do with that. If you look at 4.3% GDP growth, we have core CPI around 2.6% right now. We have wages exceeding above inflation. That's signs of a healthy economy. But we need the consumer to continue to spend. During the first half of last year, AI infrastructure spending matched the contribution to GDP of the consumer. The consumer historically accounts for about 70% of GDP growth.
Right.
So if the consumer shifts to servicing all their outstanding debt as opposed to spending, the economy will
You
slow
call the
further.
consumer she. Everybody calls it
Proverbial
consumer
day.
she. Every retail person we have on calls her she, accurately.
Oh, where to go with that one?
I'm not going anywhere with that one.
In life.
Let me ask you a different question, which is to the extent you have this thesis for the year,
Yes.
how much does it depend on the Fed getting any more sort of loose, if you will? Does it depend on a new Fed chair coming in and saying, hey, we got to go lower?
I don't
That's a good question. Very good question. That's a good question.
think the market should be looking to the Fed for any answers in 2026. They told us after their last meeting to just expect 1 rate cut at 25 basis points this year and 1 more rate cut at 25 basis points in 2027. I take them at their word. Perhaps when the new Fed chair comes in May, we get those 2 rate cuts this year as opposed to 1 and 1. But they told us their neutral rate is 3%. We're only 50 basis points away from that neutral rate of 3% right now. So we don't necessarily need more accommodation for this economy to continue to grow.
What's the GDP next year? The administration says it can do 5. You believe 5? So would you be? Do you believe 4 is possible?
I believe 3 is possible. I think 4 is a stretch. I'd be very happy to see it, but a lot of things have to go right.
Will people be cranky about the economy next year, like supposedly they are right now?
People seem to always be cranky about the economy. People always find reasons to be concerned, whether it's the upcoming deadline for the federal government.
They can't buy groceries. They're really.
Of course.
Can they buy groceries easier with wages rising?
Of course they can.
So maybe that'll help.
That will certainly help. Shelter costs coming down will help. Lower energy.
Very good, very interesting perspective. Very good explanations from both of the individuals, from both of the 2 videos, the previous one that I react to before this one and this one now. Both individuals, explain the market dynamics very well in terms of, what could propel the markets in 2026, heading into, the end of the year to end off the entire, as 2026 is just starting. So anything can happen. But I think both individuals, laid out some great points that I just want to highlight for you guys, just to explain to you guys, what they're talking about. So in terms of the markets, right, what they're explaining to us is that there's several different factors that can help to propel the S&P and the overall general market to propel higher in 2026. One of them is earnings growth. The second thing is the spending within different sectors. So that could be AI, that could be infrastructure, that could be many different industries, right? The third thing is margin expansion from profits that companies may earn, by reporting through their quarterly earnings, right? That's the third point. And last but not least, Federal Reserve rate cuts, right? And also to GDP growth. So actually 5 things, right? So keep these 5 points in mind, right? These 5 points in mind are this: earnings growth, expanding margins, right? Earnings growth, expanding margins, Federal Reserve rate cuts, GDP growth, and spending. All right, guys, those are the 5 points to keep in mind, right? So those 5 things can propel the markets higher in 2026. As I said, anything can happen, but based on what both of these individuals said from the video I watched before this and from the one that we're watching now, and as the video is finished, I think those factors could help to propel the markets higher. Now, we will have to see how that materialize in the quarterly earnings and actually in GDP growth and actually in those numbers to see what effect will that have on the market, whether that will send the markets higher or send the markets lower. So once again, the 5 points to keep in mind that could propel the markets higher in 2026, based on what the two experts are saying from both of these videos that we reacted to, the one previously and the one now. So the five main things are this, right? Earnings growth, Federal Reserve rate cuts, margin expansion, right? Margin expansion, spending, and GDP growth. All right, guys. So keep those 5 points in mind. Now, based on what they're saying and based on what I'm seeing in the charts, I think that in 2026, I think that the bull market, right, could possibly continue in 2026 with some pullbacks. I think that first we're going to have a pullback first in the market. I don't think that we're going to just go up higher, straight up higher in the first half of 2026. I think that we'll probably have a major pullback before we have our next leg up. And who knows, we may have a major pullback for a couple of months and it may last for a very long time. It may last for a year. But however, based on what I'm seeing in the charts, anything can happen. I just want to mention that again. Anything can happen in the markets where any news and any narratives could shift. It could shift in investor sentiment. It could shift anything that happens with their market dynamics. So just keep that point in mind, right? So just remember those things and remember those 5 points that I mentioned, all right, guys? So as we reacted to those two videos, my perspective is this, right? 2026, the market can go up higher. However, I think that we will have a stock market pullback or stock market crash before we get our next leg up. And that's just strictly based on technical analysis, right? Because and also too, right? Despite that we're in earnings season now on the financial markets, despite earnings season, I think that despite great earnings seasons that we may have from different sectors, especially from the financials, the tech sector, the healthcare sector, we may have great earnings from the healthcare sector, but especially the financials and the tech sector, the Magnificent Seven stocks, we may have amazing results from the tech sector. And for most of the financial sector, most of the stocks in the banking sector, they've had tremendous earnings. So we'll have to wait to see what does the earnings look like for the tech sector, right, and other sectors as well. So I think that despite the fact that we may have a great earnings season, we may have great earnings growth, right, in addition to the other four things that I mentioned here, right, I think that despite the great earnings season, I don't think that the markets will go higher in the short term. I think that probably in a year or even longer, we may have a pullback in the first half of 2026. Who knows? It may last longer than that, right? But we may have a minimum 10% correction or even more in the first half, leading up to possibly, let's say, by summertime or even towards the ending of 2026, right? But always remember that these year-end targets are just projections, right? We're analyzing based off of different things. I'm analyzing this based off different things that's happening within the markets and that's happening within technical analysis, right? So I'm just giving you guys my year-end projections based on what I see on the charts, right? These individuals are using different metrics. They're using, they mentioned a lot of key points that were in correlation with each other, right? But I'm just letting you guys know what my thoughts are in terms of what I'm seeing on the charts, despite the fact that despite that we have all these great things going on for the economy and for the financial markets as well. All right. So let's actually go into the charts. So I'm actually going to show you guys what this looks like on the charts, right? So first, let's go into the S&P 500, right? The S&P 500 index. This tracks 500 of the largest publicly traded companies in the stock market. So we're looking at here on the daily chart over a 5-year period. So as you see here, right? On the S&P 500, right? These trend lines connects all the pivot highs, all the highs, going back all the way. This all the way goes back all the way to 2020, connecting all the lows from 2020. So this was the bear market, and then the bull market of 2021, then the bear market of 2022, leading up to the bull market between 2024 and 2025, right? So pretty much right here, this is where the bull market started from 2023 and up. So as we see here, we had a little bit of grind up, then we came down, and then we went even higher, right? So this connects all the pivot highs and all the pivot lows over the past 5 years in the markets. And as we're now in 2026, we're in a new trading year. All right. So what are the levels to watch it for on the S&P 500, right? So keep this in mind, right? On the S&P, I want you guys to pay very close attention to this pattern, right? There's a pattern right here on the S&P 500. This pattern right here, where you see like this trend line, this resistance level, and this trend line converging with each other. They're almost intersecting with each other, right? In technical analysis, this is what you will call a wedge pattern. And what happens in a wedge pattern, right? This is what typically happens in a wedge pattern in technical analysis, right? Price, this is what happens, right? Price starts out very wide and gets squeezed even more and it gets squeezed over time. And what happens with price action is this, right? Eventually, when price action gets squeezed over time, it starts to consolidate, right? So when it starts to consolidate now, it has two options, right? Price will either have a massive break to the upside or a massive break to the downside. That's what wedge patterns do in technical analysis. And this is from years of me, studying this for several years. This is based on several years of my experience of studying these charts and studying technical analysis. So I'm showing you guys based on my analysis of technical analysis after years of studying this, how the markets tend to act when it comes to different technical patterns and on the technical analysis, right? So this wedge pattern, right? We're forming a wedge pattern here. This goes back all the way back to April, the beginning of April. Now we're in the almost to the middle of January of the new trading year. So this trend line right here, as you guys can see, this trend line right here connects April lows all the way to the end of November, then to the almost the middle of December, then to the beginning, then to the end of December, and then to the start of January and almost to the middle of January, right? So this trend line connects this low, connects this support level, this support level, this support, and this support. So every time we've hit this trend line right here, this trend line right here, every time we hit this trend line, this has been massive support, technical support on the S&P 500. So keep that in mind. Now in technical analysis, I want to say this, right? I just want to emphasize this point. Whenever we hit a trend line, whenever we hit a level more than 3 to 4 times, so as you can see, we hit it once, right? Not pretty much of a major hit, but now we've hit it twice, we've hit it 3 times, we've hit it 4 times, and we've hit it 5 times. As you can see here, right? Look at this, right? So right here, this was Wednesday. This was yesterday, right? Markets, this S&P almost broke below this wedge pattern and almost broke below it. It didn't confirm below, almost broke below, but came right back above this level, right? Right back above this support level, right back into the wedge pattern. So as we can see here on the S&P 500, right? We've hit this level so many times. We've hit it once, twice, 3 times, 4 times, 5 times, and potentially 6 times, right? And typically in technical analysis, whenever, like let's say for in the case of support, whenever a trend line gets hit many different times, more than 3, 4, 5 times, many times when the trend line gets hit that many times, is vulnerable to being broken down and broken down and confirmed below. Now, what does that mean in terms of technical analysis? Let's say if this wedge pattern breaks, let's say if it breaks tomorrow or next week or in the next 2 weeks or in the next month or so, right? If this technical pattern breaks, right? If this wedge pattern breaks, right? A break below a wedge pattern doesn't mean that it has confirmed. Whenever in technical analysis, when you see price breaks especially a wedge pattern, whenever price action breaks below a wedge pattern, you have to look for the confirmation below that break to understand that, okay, now we're in an official confirmation towards the downside. So in the case of the wedge pattern, right? Now I'm showing you guys what the downside is, right? And I'm gonna show you guys what the upside is in a few. In case of the downside, right? If this wedge pattern breaks to the downside, right? If this breaks, right? If we break below this wedge pattern and confirm below this wedge pattern, then what are the key levels to watch out for the S&P 500? These are the two key levels of support that I want you guys to look out for on the S&P 500. If we break below this wedge pattern and confirm below this wedge pattern, then the first level of technical support on the S&P 500 will be right around 6112 or right around 6100 on the S&P 500. And if we break below and confirm below this technical support level, then the next potential technical support level on the S&P 500 will be around 56, 61, 30. So keep those two levels in mind for the downside on the S&P 500 in any case that we break below and confirm below this wedge pattern. All right, guys. So that's on the downside risk. Now let's look at the upside, right? upside, right? Let's look at the upside now. Now, if you look at the upside, I've created trend lines that connects all these lows to all the highs, all the lows to all the highs. Let me actually zoom out so you guys can see what I'm talking about. So all the lows to all the highs, right? Now, as we can see here, right, the S&P 500 could have some near-term upside, right? So the first level, if in the case that we do break out of the wedge pattern towards the upside now, if that happens, right, we could have some resistance right around 71.56, right in that area. And if we break above that level and confirm above that level, then we could have a near term or even long term target of around 75.38. And typically in the markets, right, markets take their time to go up and they take their time to go down. I want to mention this as well. Markets typically don't go up and they don't go down in a straight line, right? So always remember that markets do not go up in the straight line and they do not go down in the straight line. So always remember that, right, guys? So in terms of the upside, right, we could hit around 75.38. And then if markets, like, let's say consolidate for a while, then we could possibly hit around 7,800 or even 8,000, close to 8,000 on the S&P 500. So that's the upside on the S&P 500. So now I've discussed the S&P chart, right? So keep those levels in mind for the upside on the upside for the S&P chart, right? And once again for the downside, right? If this wedge pattern never breaks, right? If this wedge pattern on the S&P breaks, if we break below and confirm below this wedge pattern, right, the first level of technical support, of potential technical support, will be around 6112 or even 6100. That would be the first level of potential technical support on the S&P 500. And if we break below and confirm below this level, then the next level of potential technical support on the S&P 500 will be anywhere around 5672 or around the 5600 area. All right, guys. So that does it for the S&P 500 chart. Let's go over to the next chart. All right, guys. So let me actually zoom out this so you guys can see this better. So that's the S&P chart. We went over the S&P. Let's go over to the next chart. All right, guys. So the next chart, this is the NASDAQ composite chart, right? This is the NASDAQ chart, right? So on the NASDAQ, right? This is the total NASDAQ composite, right? So on the NASDAQ, this chart goes, this is another 5-year chart. This trend line, these two trend lines, resistance and support, right? This is resistance, this is support. This connects all the highs going all the way back to 2021 and all the lows from 2022, and then the recent low in 2025, and then the recent highs in the end towards the end of 2025 heading into 2026. So as of right now, the Nasdaq composite is around 23,530. So as of right now, the Nasdaq, right, is relatively trading sideways in terms of market price action. Now, what's going on the Nasdaq composite, right? The Nasdaq composite is also in a wedge pattern. Let me show you guys, right? So look at this wedge pattern on the Nasdaq, right? This is another wedge pattern. Like I said to you guys before, on a wedge pattern, right? Two things can happen. Price can either have a massive break to the upside or have a massive breakdown to the downside, right? So price starts off very wide, then price eventually starts getting squeezed and tighter, and thus, whenever this happens, price action either makes a decision to have a massive break up or a massive breakdown in price action. Now, in the case of the Nasdaq, look at this on the Nasdaq composite. This trend line right here that connects all the support. We hit it once, we hit it twice, 3 times, 4 times, and 5 times. We almost broke down below it, right? Let me actually zoom in on this so you guys can actually see what I'm talking about. We almost broke down below it as well. Yesterday, we almost broke down below it, but we did not officially break down. We came right back up right above this support level, right back. So we're right back into this wedge pattern, right? So what are the key levels to watch out for on the composite, the Nasdaq composite, right? So right here is the support level, this trend line, right? In case if the wedge pattern breaks, right? For a possible downside on the Nasdaq, in case if this wedge pattern breaks, in the case it breaks, right? If it breaks to the downside, right? These are the levels to watch out for on the Nasdaq. In the case that this wedge pattern breaks on the Nasdaq, always remember whenever a wedge pattern breaks or whenever any level breaks, you want to look for a breakdown and a confirmation below that breakdown, right? So just keep those 2 points in mind. All right. So for the Nasdaq, if in the case we break down below and confirm below this trend line right here that connects all the support levels, and always remember that, as I told you guys before, whenever a trend line gets hit multiple different times, it makes the trend line more vulnerable to being broken down and confirmed below, right? When it comes to the downside, right? And when it comes to the upside, that can also potentially happen on the upside as well when a trend line gets hit multiple times towards the upside, right? If it's forming a bullish sentiment, right, on the charts, it can happen to the point where the trend line gets hit multiple times and thus it gets broken above and confirmed above, sending the price action more towards the upside, right? So it could happen both ways on the downside and the upside. I just want to emphasize that point. So on the Nasdaq, right, the Nasdaq Composite, right, we could get some massive support right around 20,052, right? We could get some support right around 20,000, right around this area right here. Could get some support right around 20,052, right around 20,052, right around there, right? So this would be one potential level of support, and then we could also get some support right around this level, right? We could get also some potential support right around this level, right around 18,527 on the Nasdaq Composite. So keep those two levels in mind, right? Now, in the case that we break below and confirm below both of these levels, then ultimately on the Nasdaq Composite, we may go all the way down to around 16,265 on the Nasdaq Composite. Potentially. It doesn't guarantee that it will do that. Same thing on the S&P. No such level is guaranteed. This is just based on what could possibly happen based on what the technical patterns are telling us on the technical analysis on the charts, right? So this is the level to look out for on the Nasdaq if we get a much bigger drawdown on the Nasdaq. All right, guys. And actually, too, on the S&P, I just want to flip back to the S&P chart to show you guys what the drawdown will look like if we were to have a massive correction in the S&P. Just to show you guys, right? So on the S&P chart, if we were to have a massive pullback that I said before, like a minimum 10% pullback, let's look at this, right? If we were to have a pullback from here, right? Pull back to around the first support, right around 6,100, will be a 12% correction. And if we go down further, right to around the $5,600 level, that will be around a 19 to 20% correction on the S&P 500. So a 19 to 20% correction on the S&P 500. All right, guys. So keep that in mind on the S&P. All right, let's go back to the Nasdaq Composite chart. All right, so let's look at the Nasdaq Composite chart. Let's see what the pullback will look like if we were to break down from current levels. Right, if we were to break down from current levels to the levels that I'm talking about here, first level will be a 50% correction. Second level will be approximately a 22% correction, and then the third level will possibly be a 31% correction on the Nasdaq Composite. All right, guys. So that does it for the Nasdaq Composite. Let's go into the Nasdaq, the Nasdaq Index, the QQQ. Right. So for the QQQ is an index that tracks all of the largest non-financial stocks in the stock market, right? This ETF or this index, majority of it comprises of technology stocks. So in this index, majority of their holdings is in the Magnificent Seven stocks. So all the stocks from the Nvidias to Google to Microsoft to Tesla and to other different Magnificent Seven stocks, right? So it's very much exposed to a lot of technology stocks. It's very technology heavy. It's a technology heavy index. So just keep that point in mind, all right? So on the QQQ, right? So on the QQQ, look at this technical analysis on the QQQ. This resistance and these support levels connect perfectly, right? So this goes back all the way to the all-time highs back to 2021, bear market of 2022 to 2023, and then as we see, we got some upside in price action. Came right back to test this support level right back in April of 2025 of last year. And now we've hit massive resistance right around the ending of October of last year. All right. So what are the levels to watch for on the QQQ? The QQQ is also in a huge wedge pattern. Now let me show you guys what that is, right? The QQQ is also in a wedge pattern. As you can see here, this resistance level and this massive support level within this price action, right? Within this price action channel, right? So we have this resistance level and this support level connects all the support back to last year of April. This support level right here, this support, this support, and this support. And look at the correlation, guys, from all of the wedge patterns that we have looked at so far. All of them, all the trend lines have been hit at least 4 to 5 times. Once, twice, 3 times, 4 times, 5 times, and possibly even 6 times, right? Once again, whenever a trend line, and specifically talk about to the downside, whenever a trend line, right, gets hit that many times, whenever price action is kind of not able to make newer all-time highs in a big way, but only fractional all-time highs, this shows you that based on the trend, based on the momentum, right, that price action is beginning to possibly weaken in terms of momentum, and thus, as a result of that, with this trend line, right, as a result of hitting this support level multiple times, this level now is becoming more weaker in terms of being more vulnerable to being broken below and confirmed below, right? So now in the case of the Nasdaq, let's say before we get to the downside, let's say we have some upside, right? If we have some upside on the Nasdaq, let me show you guys what those levels look like, right? If in the case we break above and confirm above this wedge pattern, right? Price starts out very wide, and then price action starts out very wide, and then it gets squeezed even more in terms of consolidation, right? Let's say if we get let's say if we get a break above in the confirmation above, we may hit some resistance right around 630, right around 630, 642. And if we break above this level and confirm above this level, then we may hit massive resistance right around 654.78, or anywhere on this resistance level. That's the upside. Now on the downside, if this trend line were to break, if this wedge pattern were to break below and confirm below towards the downside, right? These are the possible levels to look at for on the QQQ, right? First level to watch out for on the QQQ, first potential technical support level on the QQQ to watch out for is around 534.72. That's the first potential technical support level. If we ever break below and confirm below this level, then the next potential technical support level on the QQQ will be right around 485.98 or 486.69. So anywhere between 485 and 486 on the QQQ. All right, guys. So I just want to show you guys that on the Nasdaq, the Nasdaq QQQ chart. So, and the reason why I'm showing you guys the charts here, because the charts could give you a guide as to what can happen in the near term, the short term, and even to in the long term. Because as I mentioned before, all the charts that we've looked at so far have been 5-year charts, right? So this has been showing us the momentum in terms of the downside and upside, right? The momentum of price action in terms of the downside and upside, right? What has been the trend? What has been the price action trend? Coming from all-time highs to near, coming from highs to lows, highs to lows, highs to lows, right? So as we can see here, right, this is the 5-year chart, and the reason I'm showing you guys this is to show you guys that by looking at a bigger time frame, right, you can understand where price action could go in the short term, and also even to in the long term once you look at the charts, because the charts can give you a guide as to what price action did historically, what they're doing now, and what they can do potentially in the future, right? But just always remember that no price level is perfect, and they can always be negated, and levels can always be, negated, whether it's in the downside or upside. So just be very, very mindful of that. All right, guys. Anything can happen in the market with news and narratives that may come out that may send stocks higher or may send stocks lower. So just always remember that. But always remember, you always want to always look at the fundamentals and the technicals in terms of the chart analysis. All right, guys. So that does it for the QQQ. Let's go into now the Dow Jones Industrial Average, right? The Dow Jones Industrial Average, for those of you who may not know, who may be new to my channel, right? The Dow Jones Industrial Average is the 30 of the most, I would say, largest and influential companies on the stock market, particularly like the Magnificent Seven. They hold a huge influence on the stock market in terms of their gains, in terms of earnings growth. And typically, whenever the Magnificent Seven moves a lot, thus, they tend to lead the stock market higher in terms of gains. All right, guys. And sometimes this happens in major ways, sometimes it happens in fractional ways, right? It all depends on what the earnings growth is, all depends on what the investor sentiment is, and all depends on what the fundamentals say as well, and many different macroeconomic factors. So just keep those points in mind. All right. So on the Dow Jones Industrial Average, right? As we see here, this is another 5-year chart going back all the way to the highs and lows of 2020, to the highs of 2021, to the lows of 2022, to another low of 2023, and to the lows of 2025. And now look at this on the Dow Jones, right? We haven't hit major resistance just yet, but look at this. Another wedge pattern is forming on the Dow Jones Industrial Average. Now look at this. As I said you guys before, price action is tend to start wide on the wedge pattern. Then typically, even if it doesn't hit major resistance immediately, price typically starts to squeeze and retard and consolidate. And thus, whenever price gets to around this area right here, it has a decision, right? And this decision that the charts often make, let me actually make this as accurate as possible. Okay, now that's a proper wedge pattern. I'm sorry about that, guys. So when it comes to the charts, right? Whenever price contracts like this, whenever price gets tighter and tighter in terms of consolidation, it makes two decisions. It either has massive upside or massive downside. And with the wedge patterns, right? I'm gonna keep emphasizing. So with the wedge patterns, right? Whenever price gets so squeezed like this, two things happen. We're either gonna have a massive upside, we're gonna have massive upside in terms of price action, or we're gonna either have massive downside. And whenever that happens, it's usually a large move either to the upside or to the downside, right? Just want to mention that to you guys, right? So in the case of the Dow Jones, right? Let's say on the Dow Jones, if we go past this level, then we can make new all-time highs on the Dow Jones. But let's say that we break this wedge pattern. In the case that we break this wedge pattern, as we can see here, we hit this level once, we almost hit it here twice, but we hit it another time here. So we hit this level almost three times, but actually we hit it two times, right? So in the case of the Dow Jones, right? In the case that we do keep hitting this trend line that connects all the support right here in the past, let's say from April of 2025 to now. So in the past couple of months, every time that we have come close to this trend line, we have gotten major technical support, right? In the case now we get to around here, when price action gets squeezed like this, whenever it gets squeezed like this, right? In the case it gets squeezed so much to the point where it has to make a decision whether it wants to have a massive breakout to the upside or a massive breakdown to the downside, right? Let's say it has a massive breakdown to the downside. If it has a massive breakdown to the downside, if it has a break below and confirmation below this wedge pattern, right? Break below and confirmation below. If that does happen, right, then we can possibly see the Dow Jones Industrial Average go all the way down to let's say to around anywhere on this support level that connects all these pivot lows, all these lows right here, anywhere on this trend line, right around let's say 41,294. But we may get a stop right here, right around 44,447. We may get a technical support there. We may get some potential technical support, but eventually, and once again, this is just based on the charts, what the charts are telling me. If we do have a breakdown and confirmation to the downside, right, we could potentially hit this level right to around 41,800 or 42,000 or anywhere on the support. Anywhere on the support should be anywhere on this line right here, on this trend line, should be potential major technical support on the Dow Jones Industrial Average. All right, guys. So I hope you guys enjoyed this video. Welcome back to another video on my YouTube channel. Hope you guys have been enjoying the video so far. If you guys are new to the channel, be sure to subscribe to my channel. I would appreciate it very much. It means a lot to me. And I hope that, my explanation of the videos and showing you guys the charts help you guys understand where the markets could go in the near term to long term. And, just understanding where price action is at and where price action is going. So hope that you guys learned something from this video. Hope I was able to help those out there who may have some confusion about what price action is doing now and what it may do in the future and what it has done historically, right? Because as I mentioned in the previous video, right, whenever you are looking at the markets, right, whenever you're looking at any asset with the markets, whether it's any asset, whether if it's stocks, ETFs, cryptos, or even commodities, right? Whether if it's any asset on any technical analysis chart, whatever asset you're looking at, you always want to look at the fundamentals and the technicals because why? The fundamentals and the technicals will help you with three things. It will help you to understand what price is historically in the past. It will help you to understand what price is at now based on different technical patterns. And it will also help you to see where price could potentially go in terms of price action in the future, where it could potentially go in the future in terms of technical patterns as well. So it can help you do those three major things, right? Understand price action historically, understand where price action is right now, and also understand where price action could potentially go in the short term to long term in the future using certain technical patterns based on what the charts are showing us. All right, guys? And also too, with the fundamentals and the technicals, I also want to mention this too. It can also help you to become a better trader and investor, whether you are short term or long term, in terms of understanding your investment strategy and knowing how to adapt your investment strategy to different conditions in the market and to different macroeconomic environments. Because anything can happen in the markets, and you want to be able to know how to adapt your investment strategy, whether you're a short term investor or a long term investor or a trader or a long term investor. You want to be able to know how to adapt your investment strategy. So that's the first thing, implementing and adapting your investment strategy. The second thing is you want to be able to mitigate against a risk in the market. And then last but not least, hedge against any market fluctuations because market fluctuate a lot. And whenever volatility hits the market, it can it can cause a lot of volatility within price action. And when that happens, you want to make sure that your portfolio or your trades are set up in a way that it can be able to mitigate against any risk and adapt to different macroeconomic conditions in the market. All right, guys. So once again, always look at the fundamentals and the technicals, because why? They help you understand price action historically, in the present time, and also potentially in the future. All right, guys. Hope you guys enjoyed this video. Hope you guys learned something from this video. If you guys enjoyed this video, hit the like button. Like this video, share this video with anyone that you think can really benefit from this content, and subscribe to my channel. And I appreciate you guys for watching another video on my channel. Make sure you like, comment, and subscribe, and also share my video with anyone that you know. And I'll see you guys in the next video. Thank you very much for watching my channel. You guys have a wonderful day, and thank you for watching.